Hello, it's Big Chads, and this is the Trading Encyclopedia Daily Education playlist on my YouTube at Chads Trading. You can find me on Twitter at Big Chads and Bitcoin Live, where I am a founding analyst. For today's lesson, we're going to talk about a fair value gap, or an FVG. You can pause and read this, of course, at your own leisure, but I'll go ahead and show you a couple images. Here is a bullish fair value gap. Here is a bearish fair value gap. And the concept of this is essentially an imbalance in the market, and it has a lot to do with institutional order flow kind of driving the price. And it's a 3-candlestick combination. So you have, in the bullish variety, green candle, and then another big green candle, and a third one. But the difference is there's no overlap between the low of the third candle and the high of the first candle. You see here visually on the imagery, there's a fair value gap. With the bearish version, you have the first bear candle. Here's the low. There's a big move in between. And on the third candle, the high of that third candle never crosses over the low of the first candle. Now, of course, the size of the gap shows a stronger move, but let's talk about what it means, what you can do with it, right? So there's an imbalance, and it's like a lot of things when you think about with gaps. Does the gap fill? Does the gap not fill? There's a few key concepts, and I'll draw it here for you. I have one example recently of a bullish fair value gap on Bitcoin. Now, what we see here is what happened. We have the price here of the high of the first candle here, and then the second candle, and then the third candle. So we have this fair value gap in between the high of the first candle and the low of the third candle, creating the gap. Now, the idea is that the price is likely going to at least come back and retest that and re-enter the zone a little bit. So you have something called an institutional order flow entry drill, where essentially it just comes in and very briefly hits maybe the top 25% of the gap and then continues. Okay. Then you have something also called a consequent encroachment, where it gets to about the 50% point. And how you can draw that, you can take, for example, you can take a Fibonacci retracement tool, and you can just draw it like that. And that shows you the 50% point is roughly right there. You can remove all those other levels. There'll be other tools, of course, that can do that for you. But again, the halfway between the high of the first candle and the low of the third candle, that's the consequent encroachment, essentially a 50%. You don't even need these terms. It could very briefly fill the gap. It could do a 50% fill, or it could do a full gap fill all the way down to the bottom before going. Sometimes it fakes out, it goes back below and regains it. But there's lots of different trading systems that use fair value gaps. They identify them as an overextension. It's been an overextension in the price. Now, if you're going to use these techniques and you're going to target the 25% point or the 50% point or the full fill, again, at each of those levels, that's when you drop down to a lower time frame. You look for some price structure. If you're here on the weekly, you would drop to a daily or maybe a 4-hour to look for something like that. Okay, and it doesn't, of course, it doesn't always work. Nothing really ever works, all the time. But let's look at an example of a bearish fair value gap. So what we have here, first candle, and then we have the second candle here, and the third candle. We see there's no overlap between the low of the first candle and that third candle. Here's a fair value gap. The price never retraced this. There was so much downward pressure. The price never retraced it until much, much, much later. Different stage of the consolidation. The trend had already turned around. So you can certainly identify these as potential imbalances such that the market's likely to retrace before it continues down, but you can't count on that happening, especially with a very strong trend. Here, this was, earlier in the trend rolling over. There was very strong momentum. So you have to kind of pick and choose your spots, of course. But the concept itself is that there is an overextension, and the price is going to come back and retrace that gap. It may retrace it completely, maybe 50%, maybe just 25%, just kind of briefly dipping its toes in the zone and continuing. But this is a fair value gap. A lot of people talk about it. There's videos on it. There's a lot of systems that use it. I don't use this other than intuitively just looking at the price structure when I think it's overextended, and then I look for it to consolidate. So this is a fair value gap, and this is for the Trading Encyclopedia daily education playlist on my YouTube at Ched's Trading. Find me on Twitter at Big Cheds and Bitcoin Live, where I'm a founding analyst. Folks, thank you so much, and I'll talk to you soon. Take care.